everyone, I am Vibha Chauhan and welcome to Chauhan Classes Funda Clear. So today I'll explain the third chapter of Class 10th Economy, and the chapter that we have got here is Money and Credit. So money and credit. Now all of you might know about these two things, like about money and credit, and in this chapter we're gonna have a look at these things, like more deeper look at money and credit, different forms of money, deposits in banks, and what are the terms of credit, those kind of things. And you know what, that around you there is some transaction going on, like aren't there? There must be some transactions going on with money and credits. So what are those things we'll discuss in this chapter? So let's start the chapter with the first topic, that is money as a medium of exchange. So money as a medium of exchange. Now around you there are many people who are doing some kind of business, some kind of transaction with the help of money. Like if you have to buy any commodity and if you have to sell any commodity, what you would need as an exchange would be money. And why is so? Like money is referred as an intermediate thing for transaction. Like you could say that if there is shoe buyer, now if you could say that if there is a shoemaker and he wants to, you could say that money is why, like when we exchange something for money, we'll use that money for exchanging something else as well. Like for example, if a shoemaker wants to buy wheat, then what he would do is that he would firstly buy that shoes, and after that for the money he will buy from wheat for that money. So you could say that money is a kind of intermediate thing for the exchange. Now earlier what used to be like, if shoemaker has to buy wheat, then what he would have to do is that he would have to look for a farmer who is growing wheat, and another thing will be that farmer should need shoes as well. Like you can exchange just shoes for wheat. So if there is a need of those shoes with the farmer, then only there can be transaction, they could be exchanged directly for goods and goods, for commodities and commodities. But if that farmer doesn't want shoes, then what would he do? You can't just change the fate, can you? So you could say that is what is called as in barter system. What happens that there is a double coincidence of wants. Like for example, if that shoemaker wants to sell his shoes, then he would have to look for a farmer, and that farmer would exchange those shoes for wheat because he also wants those shoes. So you could say that is known as double coincidence of wants. But nowadays there is no such thing. Like we don't even use those kind of things, like we have to exchange commodities with commodities, goods and services with goods and services. But there is an intermediate thing for transaction, for exchange, you could say that is money. Like when you can just use money for buying commodities, for selling commodities, for any service, in exchange for any service as well. So you could say that is why money is also known as the medium of exchange, because with this money, with any money, you can just exchange anything for anything, and that is why money is known as a medium of exchange. Now the next topic that we have here is modern forms of money. So modern forms of money. Now you know what, that like we have, like today we have different forms of money as well, and what are those? Like if we look at those, there will be long from history. So you could say that let's discuss about them as well with the subtopic, that is currency. So currency. Now you know what, that earlier if you talk about the currencies, all of you know that what currency is. And when we talk about money, what happens that from a long history we had cattle and goods, some kind of goods as money, and after that we have metallic coins as well. Like we had Gupta period coins, we had Mughal period coins, the coins from Akbar's reign. We have different kinds of coins made up of gold, silver and precious metals like copper as well. But nowadays there is no such thing. Like we just use notes and coins that are not made of any precious metal as they were used to be in history. Like early times there were money which were made, there were currencies which were made from a very, very precious metals. But now there is no such thing. Like the rupee and you could say that like the money that we use in our country, the currency for our country is not from a precious metal, is it? Like it is just made from paper. When you see it scientifically, it does have its value, value. Like when you take the note of 2000 rupees and 10 rupees, it will definitely have its value. But when we talk about scientifically it is just a paper, isn't it? So you could say that why it has gotten its value, because it has been authorized by the RBI, by the Reserve Bank of India, that you could say authorizes all the money in our country, all the currencies in our country, and no other individual or organization has the right to issue money on the basis of this. So you could say that only RBI only RBI in our country has the power to issue money or notes, or you could say coins. And you know what, that there's a rupee. Like rupee has been accepted as a medium of exchange in our country. We do have currency, but we should have some unit for that currency as well, and that is why we have rupee as a unit of that currency that is widely accepted in our country. Legally you can't just refuse. If you're exchanging something and you're getting rupee, you can't refuse for that. You can't refuse rupee for a legal exchange. So you could say that is currency. Like we have, every country has its own currency. Like the US, like in America we have US dollars, and in China we have yuan, and in Japan we have yen. So every country does have its own currency, and our India does also have its own currency, that is rupee. And after that we have coins as well, like coins that are also used nowadays but aren't that much. Like we don't just, they are the change of money, you could say. Like there are coins of less value as well. So you could say that the currency that is widely accepted in our country is rupee. After that we have the next subtopic, that is deposits with banks. Deposit with banks. Now another type of money that can be stored, that can be, you could say, saved, is deposit with banks. Now what happens that they, in some cases, not in some cases, like there are many cases when there is a time in your life you would have a lot of money and you can't just store them in your house, you can't just take them, put them in your house, can you? And that is why we deposit those cash into the banks. Like for example, if there's a worker who is doing work in a company and is getting his salaries in the first or second day of the month. Now what would happen that in the first week of the month he would definitely have a lot of cash, and you can just use that much cash for your expenses, daily expenses, and that is why he would deposit those cash, that kind of cash, into the banks, and would receive a percent of interest as well. So the bank offers interest on that payment as well, and you would just store your money into the banks. So you could say that the deposit with banks is another type of money, is another type of saving the money as well. And you know what, that there is anytime, anywhere you can just withdraw the money as well. It's not like you have given the money to the banks then you can't withdraw from the banks. You can obviously withdraw from the bank anytime. Like it's not a kind of prohibition that you would have to withdraw money from this to this time. You can withdraw any day, any time, and you could say that as you require and when you require, you can just withdraw the money. And you know what, that banks are secured. Like if you if you deposit your money in the banks, what would happen that it's a secure place to save your money, to store your money, and after that you can just withdraw them, can't you, whenever you want that. And you can take loans from the banks as well. We will see that later as well. So you could say a deposit with banks. And there is another facility in the banks, that is of checks. Now checks, you might have used it too. Now what happens that check is a mode of payment, you could say. Like if you want to transfer some money to others' accounts, like you know what, that in a bank you need to have an account number as well in your name, so that you would save money, you would transfer deposit into your account number. And you know what, that if you want to transfer money to someone else by account, then what would you do that you would give him a check of like 57,000, of 60,000, or of 1,000 as well, and in the name of that person, and then that person would take it to the bank and it would show to the cashier and accountings, and that those people, what they would do that they would give that money, they would withdraw the money and give that money to the person on whose name the check has been written down. So you could say that check is a mode of payment by which you can transfer money to someone else's account, to someone else. Like today checks are used widely in our country, and that is why you could say that banks are also like this. They have this facility, they have the facility of checks as well. But you know what, that the banks can't use checks and withdraw money for their own selves. Like they can't just use for themselves as well. Now the next topic that we have here is loan activities of banks. So loan activities of banks. Now you know what, that bank also transfer loan. You might have seen that people are taking loans from banks. So how is it possible? Like how would they get that much deposit? Like they don't have a tree of money, do they? Now you could say that what happens that like there are many people who have their account number in each bank, and that is why that bank would have a lot of cash. And you know what, that on a particular day there is only about 15 to 20% of cash available of the total money deposited by people in the bank. So you could say that only 15% is available in the banks, and other remaining 85% would be used as for, you could say, giving the loan to the people who are in need of the loans. Now that 15% is kept in low, so that if what happens that some days like some customer may come, some people may come to withdraw their money, so that cash would be balance would be enough for them. Like they won't just use all the money, they would only use the money, they would only withdraw the money that they have deposited. So you could say that what happens in banks, that they give loans to the people who are in need of loans, who want to start their business, who have bought a house, who have bought a car. Now that loan is provided by this deposit that are deposited by the money that is deposited in the banks. But as there is no need of that much cash in the banks, that is why 85%, like 70 to 85% is kept out and is given as loans for the people, and if 15 to 20% is kept in the bank, so that anytime if a person comes, he would just take its money. Now you know what, that in this way you could say that the role of the bank, the cash is balanced, because after loans have to be given in an interest rate, and through that interest rate they would regain their money. The banks would regain their money and would, you could say, that would store it as cash in their banks. So you could say that you could say difference between the rate of interest to the, you could say that there is a kind of good kind of circle that is being made by banks. Now what happens that money from the surplus people who have a lot of money to those borrowers who have less money or who are in need of money is given, and it is maintained, like the life cycle is maintained. And after that, you know what, that banks have to gain their profit as well. There should be some rate of income for the banks as well, and that is why what happens that you could say that some rate of interest is provided to the depositors, and those people who have borrowed money from the bank would have to give some rate of interest as well. So the difference between that rate of interest to that rate of interest that is given to the people would be counted as an income of those banks. So banks act as intermediate way of you could say balancing the money among the people, from surplus people to those borrowers who are in need of money. So this is how loan activities go in banks. After that, we have the next topic, that is two different credit situations. So two different credit situations. Now around it there are many transactions going on, and most of them are probably in the form of credit as well. Like they include credit loan today. Now credit is a mode of payment. Credit is a mode of payment which refers that whenever a lender gives some goods, services, or commodities or money to a borrower, and as for a future promise for repayment. So you could say that in credit what happens that there is a lender and there is a borrower. The lender would lend money to the borrower, and borrower would have to repay that money, would have to give a promise, like future promise of repayment after 2 years, after 3 years, or maybe a month, that kind of things. There are some terms of credit as well that we'll discuss later in this chapter. Now we have to look at two stories given in our book about the, you could say, credit situations in our country. Then the first story given in our book is that of festival season. Now the festival season is coming after 2 months, and Salim, who's a shoemaker, has been ordered by a big trader to make 3,000 pair of shoes within a month. Now for making 3,000 pair of shoes, it's not just a magic, is it? He would need a lot of work, some workers, some work help, you could say. He would have a lot of expenses for buying leather, for buying equipment, for buying things for making shoes. But for that he would need some money, wouldn't he? And that is why he has two sources of credits. Like he has two sources of credits for making those pair of shoes. Now firstly, the leather that he has bought is for free, like he has borrowed it, and after that he would give the money for leather. And secondly, there is advance payment by that big trader. You know what, that big trader has given money for 1,000 pair of shoes already, so that would help Salim a lot. And after a month, when the all work has been done, he has a very good profit. He has profited a lot and has given money to those workers and has done the repayment of all the credits that he had taken. So you could say that in this case the credit plays a vital and positive role, so that Salim has more profit, more value before. So you could say that what happens in this case, that credit is helping that person for making profit, for having money, and playing a vital and positive role. Now the second case given in your book is of Sapna's problem. And our Swapna, who is a farmer, now she grows groundnut in her 3 acres of land. Now you could say that she has to take some money, she has to borrow some money from a money lender on a very high interest rate for growing groundnuts on her land. Like she would need money for fertilizers, for pesticides, insecticides, for equipment in the land, and that is why she has borrowed some money from the money lender at a very high interest rate. Now after that, what happens that some part, much part of her crop has been destroyed, even though she has used a very good quality of pesticides. But because of pests, her crop has been destroyed, and that is why she can't repay what she has borrowed from that money lender. And after that, she had taken a new fresh kind of loan from that money lender again, and another year she has a good crop, but it's not enough. Like it is okay to pay the newly won loan, but it's not enough to pay the old loan as well. So now she is a kind of debt trap. Like she can't pay for what she had borrowed. The old loan she can't pay because of her crops. Like her crops had been destroyed, and that is why she couldn't pay what she had borrowed. Now what happens that in rural areas, mostly people are dependent for their income on crops. The farmers, there are many people who do crops, you could say, who do farming in the rural areas, and that is why their credit is also in the form of crop production. Now from the day on which they buy the inputs like the pesticides, insecticides, those kind of things, and from the day of their crop, like harvesting, that there is a minimum time limit of 3 to 4 months, and you could say starting the season they take the bill, you could say that they borrow the money from the money lenders at a high interest and promise them to pay their interest when their crop has been sold. So from the money they would give their loans, they would repay their loans. And what happens that when their crop is not in a good condition, is not enough, has been destroyed, those kind of things, then they would be unable to pay their loan, you could say, to the money lenders, and that is why they are trapped in a vicious cycle and what is called as debt trap. So in Swapna's case, we saw that credit, instead of helping her to improve her earnings, has led her worse off. Like although you could say that she has been worse off even before because of the credit. So you could say that credit at the same time play a positive and vital role, and at the same time it can be very dangerous, you could say that it can let the earnings very worse off. And what happens that it depends on the risks and whether you are able to pay or not. So you could say that it depends on the risks of the borrower whether they can pay it or not. If they have some kind of asset, if they have something to pay on. So you could say that is two credit situations in our country, how credit works in our country. After that, we have the next topic, that is terms of credit. So terms of credit. Now what happens that we have some terms of credit as well. Now first of all, we have the interest of rate. Now whenever money has been borrowed, money has been lent by a money lender to a borrower, what happens that he would definitely ask for some interest rate, wouldn't he? But that would be high as well. Now that interest rate is like, that interest rate would be per month or per annum that has to be given by that borrower. And after that he would have to give repayment of the loan as well. So with the interest rate he would have to repay what he had borrowed as well. Now after that there is a thing of collateral as well. Now collateral is an asset that is owned by the borrower, and he uses that asset as a guarantee for paying his loan to the, you could say, to the money lender. Now generally what happens that collateral are cattle, land titles, those kind of properties and those kind of things. Now when the borrower is unable to pay his loan, what happens that then the money lender has the right to sell those properties, to have the properties in his name, or he can sell it as well. So collateral is an asset that is used as a guarantee for the loan, for security of the loan. So the terms of credit are interest rate, the, you could say, collateral and documentation required, and after that we have the mode of payment as well for the terms of credit. Now mode of payment, like it has to be paid by cash or checks or those kind of things. So you could say that mode of payment, interest rate and collateral together make the terms of credit. Now remember one thing here, that the terms of credit may vary substantially from one lender to another lender. It depends on the nature of lender and borrower. Like if you borrow some money from you could say from banks and from the money lender, there would be difference depending on their nature. So you could say that this is about the terms of credit. After that we have the next topic, that is formal sector credit in India. So formal sector credit in India. Now there can be various types of sources where you can have the credit from, and that is why they are also grouped in two groups: formal sector credit and informal sector credit. Now formal sector credit includes banks and cooperatives, and informal we have money lenders, friends, relatives, employer, traders, etc. So you could say that formal or formal, informal or just informal. And what happens that you could say that there is a difference between these two as well. When you borrow some money from a money lender and from a bank, what happens then bank would give you the money, would lend you the money at low interest compared to money lenders, because what happens that all the banks are in a supervision of the RBI, of the Reserve Bank of India. Periodically they have to give some report to the RBI about what they have lent to whom, so that it would not be like they are only giving the money to those people, those rich people or those kind of people, big people, but not small scale industries or those who want to set up a business. So that has to be supervised by RBI. But money lenders and informal sectors, for informal sector there is no such thing. Like they can lend money at whatever interest rate they want, and they can use any kind of means for you could say for taking back that money as well. So you could say that those informal source of credits are supervised, are monitored by the RBI. Like all the banks are monitored by the RBI. Like periodically they would have to give report and those kind of things. But there is no such thing in informal sectors. And what happens in informal sectors, like by money lenders, what happens that compared to formal sectors, the interest rate, the rate of interest are so high, and that is why there would be high cost of borrowing. Now what happens that when a borrower has a lot of high rate of interest, then it would not increase his earning, but instead it would decrease his earning, because he would have to give a big part of that earning to the money lender as an interest rate. So you could say that instead of increasing his income, it would instead decrease his income. And after that what happens happens that there are many borrowers who have borrowed money for setting up a business or a small scale industry or to start an enterprise. But what happens actually is that they will have to pay a very high rate of interest, and that is why they can't start their business or small scale industries or start an enterprise. And after that we have some other examples as well, like because of high cost of borrowing, you could say the borrower is not in a condition to pay the high rate of interest, because the part of his income would be given as a rate of interest. So what would be his profit in that kind of lending and borrowing, in that kind of loan or credit? So you could say that is why cheap and affordable credit is very essential for the country's development. Like if there is less rate of if there is less interest rate, then what happens then people would be able to pay that interest rate and to start up their business as well. That is why RBI also supervises the banks to see that it isn't giving only money to the rich people and those kind of things. The banks have to give loans to those people, like you could say small industries, enterprises, startup people. So you could say that the loan has to be provided to all the people. So if there is less cost of borrowing, then there will be more development in the country. That is why cheap and affordable credit is very, very essential for the country's development. After that, we have the subtopic that is formal and informal credit. Who gets what? So formal and informal credit, who gets what? Now you know what, that when we talk about formal and informal credit, now what do you think, that which people would get more and more formal credit and informal credit? Now in the graphs we have 4 graphs in the urban households. Now first is of the poor households. Now in poor households, what happens that 85% of their credit, of their loans are from informal sector, and the remaining 15% are for formal sector. So you could say that only a little part, only 15% is from formal sector and 85% is from informal sector. After that we have houses with few assets. Now those houses have loans around 43% from formal sector and 57% from informal sector. And when we talk about well-off families or well-off households, now they have around 28% loans from informal sector and around 72% loans from formal sector. And the rich households of urban areas have 90% of their whole loan from formal sector and 10% from informal sector. So you could say that like we have seen that in these graphs, what we can observe is that in urban areas the rich households get more loans from the formal sector compared to poor households. Now poor households have more loan from the informal sector. That should not be. They should have more loan from formal sector, then only they can be in profit, they can be in a good condition. Otherwise the gap between the poor and rich would be widened. So you could say that when there's a question who gets what, you could say that in urban areas, well, not just in urban areas, it is a story of rural areas as well. Like even in rural areas we have rich people who have more loans from formal sectors, and we have poor households who have more loans from informal sector but less from formal sector. And what happens, you know what, that those rich people have cheap and availing credit from the banks, and poor households can't get that, like they are not eligible and they just can't get loans from the banks as well. So there are some things that must be in our country. Firstly, the loans should be provided, the formal loans should be provided in each and every region of our country, in every rural area in our country, so that banks would be present in every rural area region, you could say. And after that, secondly, there is a need, so you could say that there would be less dependence on informal sector. But secondly, what we need is that there should be equal proportion of loans as well. It should not be like formal loans are there but they were provided only to rich households. It should be provided to poor households equally as well. So you could say that these two things have to be done in our country for country's development. After that, we have the next topic, that is self-help groups for the poor. So self-help groups for the poor. Now what happens that we have seen that loans can't be provided to poor people that much. Like there are some reasons behind it. You could say that in rural areas obviously there are less loans, like you could say less loan providing banks. And after that, even for a loan from a bank, what you need is that paperwork, collateral and those kind of background as well. Now whenever you take a loan from a bank, what they would need is that you must have some property owning, like you must have some collateral, you must have some background, good background, so that you would be able to pay the you could say loan as well. And that is why poor people can get that, and they have to borrow from money lenders and get themselves trapped. Now firstly they would have a loan, but they would not be able to pay that. After that, money lenders would provide them, like money lenders personally know those borrowers, and that is why they provide loans even without any collateral, and but they are at a very high interest rate, and that is why those people are trapped in a debt trap. And there's a scheme in rural areas that is started now, that is known as SHGs, like self-help groups, particularly for women. Now in a particular, what happens that self-help groups is a group of people, particularly 15 to 20 people, 15 to 20 members are there, and what they do is that as a group they have their savings, they save their savings. It can vary from 25 rupees to 100 rupees depending on the background of the person. And after that, when they have enough savings, whenever someone wants to take a loan, what he can do is that he or she can do is that she can take loan from its own group, like his own group he can take loan, and there would be some terms of credit as well, like there would be some interest rate, but that would still be less compared to many lenders. There would be time schedule and those kind of things. And after a year and two, what happens that group would be eligible for loans from the banks as well. So now the loans would be provided to that particular group in the name of group, not in the name of member. And whenever you could say that loan has to be paid off by the group and a member is not in a condition to pay, then what would happen that the other members would pay for him, you could say for instead of him. So you could say that is why that loan has been provided to the group in the name of group, not in a particular individual member. And now you could say that unity is strength lies in unity, and that is why when people have come together as a group, self-help group, they would obviously be more empowered. And particularly you could say generally we have women self-help groups in our country. Now when they come, they have meetings as well, and through these meetings they discuss some other issues in their, you could say, in their villages and in their rural areas as well, about women empowerment, about health, about education. Those kind of things could be seen. Like you could say that whenever there's a meeting between people, they would definitely talk about issues for themselves as well. And why you could say that this method is so reliable, is so good, is that people have come together, they would talk about issues and would store there, would gather their savings so that they would be provided, each member can be provided with loan. And that is why self-help groups are very good. After that, we have the next and last topic of this chapter, that is summing up. So summing up what you can conclude from this chapter. Now in this chapter we talked about money, the type of money like currency, and we had different forms of money in currency and deposit with banks. In banks we have a good mechanism, like only 15% is there. There's a balance. You could say that in banks there are those who have surplus money, who are the lenders. You could say directly or indirectly they are the lenders, aren't they? And after that we have borrowers who take money from the banks, and in both cases we have some interest rate as well. Now depositors have been paid off with some interest rate, and you could say that those borrowers have been charged with some interest rate as well. Then we talked about credit that can be vital and positive, but at the same time it can let you worse off as well. We have some terms of credit like interest rate, collateral, and documentation required for the collateral, and you could say mode of payment as well. After that we talked about, you could say, the different forms of credit as well, formal sector credit and informal sector credit. We already have seen that there is need of more formal sector credit in rural areas for rural people, and you could say that after that we we talked about the SHG, self-help groups, that are very reliable methods in our country, and that should be promoted more and more. So you could say that is all we have discussed in this chapter. I have covered all the topics and subtopics, and the last remaining 2 chapters of this book will be covered in further upcoming videos. So stay tuned for the upcoming videos. Thank you very much.